Has anyone ever told you there's only one way to profit in crypto? Well, some swear by locking up coins to earn consistent rewards, while others believe in loaning them out for potentially bigger gains. Today, we're diving headfirst into that debate with our video, Staking versus Lending. Which crypto strategy earns you more? Inspired by our thumbnail's challenge, who wins? I'll unpack the benefits of each path in detail to help you figure out which one better suits your own financial roadmap. If you felt uncertain or even overwhelmed by the choices in this fast-moving space, you're not alone. This content lays out key insights for anyone longing to build reliable streams of income or seize higher returns without blindly taking on massive risks. We'll uncover the hidden advantages most folks overlook, sparing you the guesswork and helping you make sharper decisions based on your goals and comfort level. Before we jump in, go ahead and hit that subscribe button, give this video a thumbs up, and turn on notifications so you'll never miss any of our daily deep dives here on Crypto Yield Pro. Let's settle the score once and for all. Stick around to the end because you won't want to miss our surprising findings. Crypto has evolved far beyond just buying and holding tokens for speculation. In today's dynamic environment, folks can put their digital assets to work in ways that were unimaginable a few years ago. There's a wave of DeFi strategies that revolve around generating consistent returns, often referred to as yield generation. By tapping into this ecosystem, enthusiasts get more than just price appreciation. They earn rewards simply by committing their tokens. Some call it the next frontier of passive income, and they're not far off. The real question is how to choose between parking assets in staking or offering them for lending, especially when both have their own perks. Crypto staking, in essence, means holding onto tokens to support network operations and getting a piece of the rewards in return. Meanwhile, lending those same digital assets through platforms like Aave or MakerDAO, now Sky, involves providing liquidity to borrowers, collecting interest on each loan. Both routes promise a fresh spin on generating value, often overshadowing traditional bank accounts in terms of potential yields. Yet, with bigger returns come bigger considerations, so balancing opportunity with risk management becomes pivotal. From a casual investor's standpoint, it's thrilling to see these innovations revolutionize digital finance. The excitement around these methods is only growing, especially now that global adoption of digital assets has picked up steam. Some folks gravitate towards staking tokens with providers like Lido, while others experiment with lending through avenues like Compound, each seeking those sweet returns that outshine conventional savings. But beyond the shiny APRs, there's a deeper conversation about what fits best with individual financial goals and timelines. That prompts the age-old dilemma. Is staking the way to steady gains, or does lending unlock bigger wins? Up next, there's a deeper dive into how staking actually works behind the scenes, so stay tuned. Lending presents a direct route for turning digital assets into productive resources. Instead of letting tokens sit idle, individuals can offer them on dedicated platforms like Aave or Sky, earning interest from borrowers in return. This model appeals to those who prefer liquid positions, since many protocols allow for quick withdrawals if market conditions shift. Compound has long been regarded as a pioneer in this space, but newer entrants like Extra Finance are ramping up competition. With varied options available, users can cherry-pick lending avenues that align with their specific objectives. One of the major draws of providing liquidity is the opportunity to capture attractive returns, sometimes surpassing typical bank rates by a wide margin. Stablecoin lending, in particular, has gained traction among enthusiasts who appreciate reduced volatility while still collecting yield. However, this strategy isn't without its hurdles. Markets can swing unexpectedly, and protocol vulnerabilities can affect one's bottom line. Building a balanced approach means analyzing both the pros and potential pitfalls of handing over assets to smart contracts. Thanks to ongoing innovations in finance, solutions continue to evolve, offering ways to mitigate these concerns. Recent developments have introduced advanced dashboards that let users compare rates and risk metrics across lending portals, making it easier to navigate the landscape. Many have found success by blending lending with other avenues, effectively creating multiple income streams under one roof. While the allure of interest payments attracts folks looking for consistent flows, there's an inherent balancing act between risk and reward. Each platform operates under different rules, so understanding the ins and outs becomes paramount for safeguarding hard-earned capital. After all, deciding whether to place assets in staking or lending circles back to one's personal priorities, which we'll dissect further in the next section. Some people picture this choice as a tug-of-war between two distinct DeFi strategies, yet it's really about finding the best fit for one's unique situation. A handy way to see the distinctions is to map out factors like liquidity, lockup periods, interest rates, and the underlying protocols. For instance, locking tokens on networks like Polkadot can yield governance perks, whereas loaning them via Sky may offer a steadier return. Each path demands proper risk management. No one wants to suffer losses due to sudden market shifts or smart contract exploits. Ultimately, the best route depends on individual goals and how comfortable someone feels with each system's nuances. Imagine lining up columns for staking and lending, then comparing how fast one can withdraw funds, how earnings fluctuate, and whether any fees might eat into profits. Staking on Cosmos or Lido typically involves a fixed commitment, but that setup might make sense for those seeking passive income without fussing over short-term price moves. Lending on platforms like Compound or Extra Finance, on the other hand, might reward individuals who plan for more fluid transactions. By laying out these details side by side, it becomes easier to see which route syncs with someone's timeline or appetite for potential ups and downs. It's also key to think about yield generation over the long haul. Staking can provide stability, with predictable reward schedules that help investors budget their inflows, whereas lending might net higher interest rates if the market's hot. At times, diversifying between both strategies can hedge bets. After all, no single protocol offers a guaranteed golden ticket. In the end, it's about exploring enough options to uncover a sweet spot that balances ambition with practicality. But how do people actually decide on a path that lines up with their personal objectives? That's the very question the next segment tackles. Deciding on a direction often comes down to how individuals view their long-term objectives. Some are drawn to steady, predictable routes that emphasize straightforward rewards and minimal fuss, a perfect match for staking on networks like Lido or Marinade Finance. Others thrive on fast-paced environments, drawn to the idea of lending through providers like Compound or Extra Finance for potentially elevated returns. Of course, there's no rule saying anyone must stick to just one tactic. Many savvy folks split their assets between multiple channels. It all begins by assessing priorities, timeframes, and comfort level with the unpredictable nature of digital assets. Before locking in any decisions, it helps to map out desired outcomes. Is the goal simply to enjoy recurring earnings, or is there a larger vision in play, like funding a future project or growing a broader portfolio? Some realize they prefer stable instruments, leaning on reliable protocols for their peace of mind. Others see the high-growth realm as an invitation to experiment with different platforms. Taking the leap might feel scary at first, yet with a well-thought-out game plan, it can open doors to possibilities that traditional savings approaches don't always provide. Each person's journey will be distinct, so it pays to examine all the angles. For a balanced perspective, many turn to trusted online resources, chat groups, or even financial advisors who specialize in modern markets. By tapping into the wisdom of others who've walked this path, newcomers gain confidence and clarity. With each new upgrade or project launch, the space shifts quickly, so staying informed remains essential. Ultimately, what works for one individual might not suit another, and that's perfectly fine in a domain as vast as crypto. Now that you've seen how holding assets can boost earnings, or how loaning them out might spark a different kind of growth, it's time to put this knowledge into practice. What if your next move could open doors you never even knew existed? Think about how each strategy, whether staking or lending, could shift your journey toward financial freedom, and then decide which approach you'll try first. I like to do both. Remember, this space is evolving constantly, so staying curious and flexible keeps you ahead of the curve. While you're weighing your options, make sure to subscribe, like, and turn on notifications to stay on top of every breakthrough we uncover. And for those eager to dig deeper, if you're serious about pushing your crypto potential even further and want to support the channel, check out my exclusive ebook pinned in the first comment below. It's packed with pro-level tips on mastering DeFi, building a perfect portfolio, and fortifying your security with insider info you won't find elsewhere. Isn't it time you took the leap and turned your crypto ambitions into reality?